All right, now that we've completed our activity variances by comparing the flexible budget to the planning budget, we're going to compare the actual results to the flexible budget. So when you compare actual to flexible, that's when you're finding your revenue and spending variances. So these variances have nothing to do with changes in activity because we're using the same level of activity. These variances, we're getting to take a look at how well costs were controlled and how well basically revenue was maintained. So let's take a look at comparing first the actual revenue to what revenue should have been at that actual level of activity. All right, so let's find that difference. So we'll take the actual revenue of $43,000 and compare that to what it should have been. It should have been $41,250 given that revenue formula. So we have a variance here of $1,750. And what kind of variance would this be? This is a revenue variance, and is this favorable or unfavorable? Well, this is going to be favorable. And why is that? Well, it's going to be favorable because of the fact that we generated more revenue with 550 lawns than we should have generated with 550 lawns. Because the flexible budget is using an estimate, a revenue formula to estimate what that revenue should have been, and we made a little bit more. So that's a favorable revenue variance. But now we have to calculate our spending variances. So with wages and salaries, we ended up spending $23,500, but we should have only spent $21,500. So let's compare the actual wages and salaries cost of $23,500 to what it should have been at $21,500. So that's a variance of $2,000. And specifically, a spending variance of $2,000. We spent $2,000 more on wages and salaries than we should have. Now, is that favorable or unfavorable? Well, that's going to be unfavorable when it comes to costs, because anytime you spend more than what you should have, that's going to be unfavorable. Now let's compare our gasoline and supplies. Well, in actuality, we spent $5,100 on gasoline and supplies. How much should we have spent? Well, we should have only spent $49.50, so what's that spending variance there? We spent $150 more than what we should have. And if you spend more than what you should have, that is an unfavorable variance. Now, what about equipment and equipment maintenance here? So we actually spent $1,300. We should have spent $1,650. What's that difference there? That's a difference of $350. But remember, drop any negatives. We only want to use the absolute value. So it's a $350 difference. So here, in this case, we ended up spending $350 less than what we should have for whatever reason. So in this case, anytime you spend less than what you should have, we will label that spending variance as favorable. So this can be a result of various different things. Anytime you see any of these favorable or unfavorable spending variances, with the wages and salaries, maybe you had people stay on for more hours than you had anticipated. With gasoline and supplies, maybe there was some waste of supplies and you had to use some more. Equipment maintenance, maybe there was less maintenance required. Maybe things were in better running condition. Whatever it may be, there's various different explanations as to why these variances exist. All right, the next one is office and shop utilities. Remember, these are fixed expenses, these last four. So we should have spent $1,000, but we only spent $950. So there's a variance here, a spending variance of $50, and this is going to be a favorable one because we spent less than what we should have. Now, we thought office and shop utilities is a fixed cost. How could that be? That we're actually spending less than what that fixed cost should have been? Well, it might be that the utility company changed its rates, and we're actually that maybe that fixed cost completely changed fundamentally. So that could be an explanation for that variance there. What about rent? Well, we should have spent $2,000 and we spent $2,000. So that didn't change, so there's no variance there. And that one kind of makes sense. Unless the rental contract is renewed or altered, we shouldn't see a variance there. Equipment depreciation, we should have spent, or we don't spend money on depreciation, right? We should have incurred $2,500 in depreciation. And we actually incurred $2,500 in depreciation. So there's no variance there. So this makes sense for it not to change. The only reason that we might see a difference here is if we maybe bought some more equipment that was depreciated, or some assets became fully depreciated and we're no longer seeing that depreciation, or we got rid of some assets that we know obviously then at that point wouldn't record the depreciation on. Lastly, insurance. We should have spent $1,000, but in actuality we spent $1,200. So that's a $200 unfavorable spending variance. So how could that be? Well, it might be that for some reason the insurance premiums went up and you're having to pay more than what you thought you would actually every single month. So in this case, that fixed cost of insurance actually ended up not staying true. In actuality, we actually had to spend a little bit more than what we thought we would have to spend. And let's find the total expenses spending variance. So we actually, if we take all expenses into account, we actually spent $36,550 in actuality when we should have spent $34,600 right here. So that's a total spending variance of $1,950. Now, is that favorable or unfavorable? Well, this is going to be unfavorable because we spent more than what we should have. Now let's compare our net operating income. Our actual net operating income was $64.50, but based on our flexible budget, it should have been $66.50. So there's a variance here of $200. Now, what would we call this variance? Is that unfavorable or unfavorable? In this case, it's unfavorable because our net operating income is less than what it should have been. Now, when we're talking about revenue and spending variances, we're talking about revenue and expenses. But net operating income, we can find its variance on its own. Technically, we can kind of lump, it's neither really a revenue or a spending variance, it's more of a combination of the two. But when you're labeling it as unfavorable or favorable, you kind of use the same logic basically as you use for finding the label for your revenue variance. So once again, we've now completed the flexible budget, but what's it consist of? Instead of just comparing your actual results to your planning budget, we've completed a flexible budget where we break down the difference between the differences between the actual and planning budget into its activity variance components and its revenue and spending variance components. Because before, when we were looking at these variances between the actual and planning budget, it gave us a little bit of insight, but not enough because we were using two different activity levels. Different activity level for what we planned for, and then a different activity level when it came to what actually happened. So to better understand these differences, what we did here with the flexible budget is break down those differences essentially between what part of those differences are due to differences in activity, and what part of those differences are the result of the company controlling costs well or not controlling costs well, and also maintaining revenue well or not maintaining revenue well. So this puts that into better perspective. Now in chapter 10, which we'll be looking at after this one, is where we'll be breaking down these spending variances into its components between price and quantity variances. So we're going to take this even a step further beyond the flexible budget in the next chapter.